Singapore REITs just fell 7.1% this year. In the same stretch, the Straits Times index climbed 22% to record highs. That's a 29 percentage point gap, and almost nobody outside this sector is asking why. I'm Iggy. I run the numbers on SGX income names so retirees don't have to guess. My job is simple, even if the balance sheet is not. I read the numbers the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. That gap I just mentioned is not about anything happening in Singapore, and today I'm showing you exactly what it is about. Let's sit with that number for a second. Down 7.1% while the broader market is up 22% is not a rounding error. That's two entirely different markets living in the same country. And the REIT side of that story deserves its own look because headlines chase chips and semiconductors, not property trusts. Here's what doesn't change. No matter what the headlines are chasing, every REIT I cover gets measured against the same 4.7% yield hurdle every single week. Same balance sheet gates too, regardless of what's dominating the news cycle. That consistency is the whole point. Here's the mechanism, and it's simpler than people think. Unit prices get judged against risk-free yields constantly. When benchmark yields climb, distributions look less attractive by comparison. Money drifts toward the safer asset, and REIT prices fall until the yield adjusts back into line. That's not sentiment, that's arithmetic. Most investors assume Singapore's own government bond is what's setting the pressure here. The 10-year Singapore government securities yield sits at 2.36% as of the 19th of August, up from around 2 to 2.2% for most of this year. That's a real move, but it understates where the actual pressure is coming from. The real driver has nothing to do with Singapore's own monetary settings at all. It's the US Treasury yield. That benchmark still sets the mood for how global capital prices every REIT valuation model on the planet, ours included. Now, the funding side of this story is not the villain. Compounded SORA is sitting at around 1.08 to 1.12% this month, essentially flat against where it was in June. Borrowing costs on new debt are not the aggregate problem here. Valuation math is, and that average hides real dispersion. Which gets hurt depends heavily on balance sheet room, not on how good the tenants are. Here's where a lot of retail analysis quietly goes wrong. Market convention says a healthy retail yield spread runs 3 to 4 percentage points over the 10-year Singapore government securities yield. Against 2.36%, that implies a market clearing floor of roughly 5.4 to 6.4%. My own forensic hurdle, 4.7%, is measuring something different entirely, a retirement suitability floor, not a market pricing convention. So we've got two numbers doing two different jobs. 4.7% is my hurdle. It clears CPF special account with margin for equity risk. 5.4 to 6.4% is the spread convention. It's asking whether a REIT is fairly priced against the current cost of long government money. A REIT can clear my hurdle and still look expensive by spread logic if the 10-year keeps climbing. And a REIT that fails on a hard gate, not on yield, is telling you something the spread convention can't see at all. Our REITs run on borrowed money by design. When loans come up for refinancing, every extra dollar servicing pricier debt comes straight out of the distribution per unit, regardless of how strong the tenant base looks. Think of it like two hawker stalls with the same queue out the door. One owns their equipment outright, the other still paying off the fryer on installment. Same crowd, same rent per bowl sold. Completely different exposure when interest rates move. Which brings me to the two names I want to put side by side today. Similar sector, similar headline yield on the surface. One clears my gates with a single narrow, asset-specific miss. The other fails on two fronts at once, and its hedge profile just shifted to more rate-sensitive, not less. The gap between them is entirely in what's underneath the number. Keppel DC REIT sits at Zone 4. Caution, a fortress balance sheet everywhere except one constraint. Mapletree Industrial Trust sits at Zone 4 minus caution, and I want to be upfront, that suffix is still provisional on my end. I've got two internal data calls I haven't locked yet on the floor question and how a specific leverage metric gets tiered. I'll flag it again when it firms up. At $2.23, Keppel DC REIT's trailing yield runs about 4.9 to 5.1%, clearing my hurdle with real margin. This is one of the cleanest balance sheets I track. And the growth read here is straightforward. The business quality is strong. One specific, nameable asset is the entire constraint. Gearing sits at 34%, below my 35% ceiling, with roughly $670 million of headroom against management's own 40% internal limit. Interest coverage runs 6.9 times, well above my 4 times floor, and stress test down to 5.1 times even under a 100 basis point rate shock. That's still comfortably clear. Occupancy is the one crack, down from 95.6% to 92.5%. And that entire miss traces to a single tenant vacating the Cardiff data center. Soft flags here total 1.0, both minor, Japanese yen debt exposure, and unverified sponsor unit holding. Here's why the near-term picture doesn't scare me. Average debt tenor runs 3.1 years, only 22.9% of the book comes due by the end of 2027, and 87% of total debt is fixed at an average cost of 2.6 to 2.7%. Most of this REIT's debt simply isn't up for repricing anytime soon. Handa. Here's why the near-term picture doesn't scare me. Average debt tenor runs 3.1 years, only 22.9% of the book comes due by the end of 2027, and 87% of total debt is fixed at an average cost of 2.6 to 2.7%. Most of this REIT's debt simply isn't up for repricing anytime soon. If you already hold this one, your distribution per unit rose 11.3% year on year, and that compounds against a yield on cost that was already favorable. If you're buying in fresh today, you're buying the 4.9 to 5.1% yield and the current occupancy impaired balance sheet, not the history behind it. Both readers are looking at the same number. It means something different to each of them. I'll say this plainly rather than dress it up. The gap between a genuine sanctuary and a name that's quietly becoming a yield trap can move in a single trading session, and the numbers I track shift faster than a headline gets written. From upside to 0-day access on both YouTube and Substack, the full Red Zone watchlist, and institutional grade cheat sheets, all for $12 a month. Now, the other name on today's list. This one's a very different story underneath. At $1.91, Mapletree Industrial Trust shows a trailing yield of about 6.57%, the highest headline number of the two. And let's be honest, that number looks attractive sitting on its own. It's also obscuring two separate hard gate failures underneath it. Gearing sits at 37.5%, breaching my 35% ceiling by 2.5 percentage points. Occupancy sits at 90.7%, below my 95% floor, with the data center segment specifically at 85% and the North American data centers alone at 82.5%. Interest coverage sits at exactly 4 times right on my floor, and I'm treating that as a failure, not a pass. A floor is a floor. Two hard gates failing independently is already enough on its own to place this in the wider suffix band. There's a third pressure point. Net debt to EBITDA runs about 5.14 times, breaching my 5 times yellow flag threshold. Weighted soft flags currently sit at a provisional 1.0 pending how I formally tier that specific metric. Here's the part that matters more than the gearing number everyone else is quoting. A single quarter ago, this REIT had 88.6% of its debt fixed and 11.4% floating. Today, that's shifted to 73.3% fixed and 26.7% floating. Debt tenor is 3.4 years, and only 8% of borrowings come due this financial year, so near-term refinancing isn't the concern. The head shift is, right now with SORA low, that shift barely bites. But if the rate environment tightens from here, this REIT absorbs more of that move faster than Keppel DC REIT does, because Keppel is still sitting on 87% fixed debt at a rate it locked in early. Distribution per unit fell 4.9% year on year, 3.11 cents against 3.27 cents a year ago. A genuine disclosed decline. And here's the difference from Keppel. For this name, yield on cost doesn't tell the legacy holder a materially better story than what the fresh buyer sees. Both are looking at a REIT generating less distributable income per unit than it did a year ago, sitting on top of two failing balance sheet gates. That high headline yield at today's depressed price isn't offsetting the problem. It's partly a reflection of it. Put them next to each other and the picture is stark. Keppel DC REIT clears gearing, clears interest coverage, and misses occupancy on one asset. Mapletree Industrial Trust misses gearing, sits exactly on the interest coverage floor, and misses occupancy portfolio-wide. Same sector, same hurdle technically cleared, completely different risk sitting underneath. So what does this mean for you if you're choosing between the two on yield alone? The number everyone screenshots is trailing yield, and 6.57% looks like the better buy against 4.9 to 5.1%. But Keppel DC REIT locked 87% of its debt at 2.6 to 2.7% before this cycle ever became a question worth asking. Mapletree Industrial Trust let its fixed rate proportion fall from 88.6% to 73.3% in a single quarter, right as two of its hard gates were already failing. A REIT doesn't get punished for a high yield, it gets punished for being unhedged the moment that yield stops being the only thing that moves. I want to be clear about what this framework is and isn't doing. If you've got a genuinely longer runway before you need to draw down this capital, you may reasonably tolerate the volatility I'm flagging here, particularly around a single asset issue like Cardiff, which has a visible resolution path. And if this is capital sitting beyond what you need for retirement income specifically, it can reasonably be held to a different standard than money that has to perform on schedule. This framework is calibrated toward retirement suitability, not every possible use of capital. And that calibration is exactly why these two REITs land in different places, despite technically clearing the same yield hurdle. For Keppel DC REIT, I'm watching whether Cardiff gets relet before the next earnings cycle. That single lease closes the entire occupancy gap. For Mapletree Industrial Trust, my watchlist trigger is the floating rate proportion, not the gearing number everyone else is citing. Two failing gates plus rising rate sensitivity in the same quarter is a different risk than either problem alone, and I'm watching whether management re-hedges before that combination compounds further. So what does this mean for you? Two REIT dates, one hurdle cleared on paper, and a completely different conversation happening underneath. That's the whole reason I don't stop at the headline number, and neither should you. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.
Let's make it happen.